Hello, everyone. Today on the Final Bar, I'm joined by Jay Petit, founder of Charts Avenue in Singapore. He'll share with us an overall take, a long-term take, really looking at monthly charts, looking at the consumer sector, and one particular name to pay attention to. Happy Fed Day, by the way. Plenty of movements in the equity markets overall, also in interest rates. In gold, we're going to do a segment called "Don't Fight the Fed," where we talk about the movement leading up to that announcement, what happened after Powell's press conference, and what to think about next. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market activity using the power of technical analysis, using the ability of technical analysis to illuminate or to quantify investor psychology, focusing on the messages of price, breadth, sentiment, trend, and momentum. One of my mentors, Ralph Acampora, others like Jeff Weiss and others reminded me early on in my career and ongoing to focus on price. If you know nothing else about a particular asset, about a particular ETF, particular stock or sector, focus on the chart first. All the other stuff a lot of times can be noise. It's sort of a narrative that fits around, but the price is what is fact. You can't restate the price, as Ralph would always tell me. Now we have Fed Day today with the Fed meeting yesterday and today, the minutes today and Powell's press conference. A lot of volatility to be expected. Overall, the market's netting out positive, but if you look in the afternoon session, there's quite a bit of choppiness. So in our segment later, Don't Fight the Fed, we're going to focus in particular about what the price action was leading up to that, those announcements, what happened afterwards, what sort of ideas we can draw out of that in terms of the next steps of the market as we digest previous distribution along with today's bounce. We have a lot of great guests on the show. I'm excited to talk with Jay Pettit again here shortly. Coming up next week, we have more great guests. We have Alessio Ritigliano joining us on the 28th. Alessio's with Wyckoff Analytics in San Francisco. On the 29th, we have Dana Lyons from the Lions Share Report and J Lyons Fund Management. Then coming up on Thursday, September 30th, one of my early mentors, Jeff Weiss, coming to us from the New York area at Clearview Trading Advisors, taught me much of what I know and use about trend lines. I all learned from discussions with Jeff. Also, as a reminder, our next episode of The Pitch is coming up next week on September 28th, 5 p.m. Eastern. I will be moderating a lot of a great discussion with John Kosar from Asbury Research, Tom Bowley from earningsbeats.com, Joe Rabel from Rabel Stock Research. It's a stock picking showdown, three experts all bringing five stock ideas. We talk through them individually, and then as a group, sort of debates the strengths and weaknesses of what everyone threw in there. A lot of fun, and go to stockcharts.com/the pitch for more information on that event. Let's continue on with our next segment, the market recap. So, as I mentioned, today's Fed Day, and there's always sort of options expiration, Fed Day, big earnings day. These are volatile days in the market. You should expect an increase in volatility, expect a lot of choppiness as people, a lot of times investors make knee-jerk reactions to not just what is said, but expectations about what is said, what might be implied, and not only what was said, but how things are said can influence the markets. And in the end, I think one of the benefits of the charts is you can see where the market nets out, right? After digesting the Fed meeting, after hearing Powell's press conference, where did things settle in? What sort of movements did we have? So if you look at the S&P price action in the last couple of days, you had obviously the distribution that you saw earlier in this week, choppiness yesterday into today, or yesterday, and then today you see the rally going into the afternoon here, 2 p.m. Eastern, 2:30, when we start to get the minutes, we start to get the press conference. You can see from there, that was pretty much the end of the uptrend. From there, it was really more of a choppy sideways sort of period. And there are a lot of sort of competing narratives that we can try and tease out a little later in the show. But overall, the S&P netting up just under 1%, closing just below 4,400 to close around 43.95, 43.96. The Nasdaq 100, Nasdaq Composite, all around that same level. We'll look in a moment here at what we call the new Dow theory, which is looking at the S&P 500, the NASDAQ composite to see how those two indexes are moving relative to one another. And long story short, not bearish yet as much as the traditional Dow theory. The mid cap index, small cap index is all up a little more than large caps, with small caps leading the way higher, with the S&P 600 up 1.6%. The VIX is still what I would consider elevated in terms of its range year to date, above 20, closing the day just below 21. Other asset classes, quite a bit of movement. And you saw with interest rates had steadily gone lower as bond prices increased going into the early afternoon. After Powell's press conference began, you saw a spike higher in rates, a move much lower in bonds, and the 10-year yield closing the day around 134. But it was a big rise in the TNX, dollar sign TNX, going into the close. The dollar index up a little bit, but just above 25 using the UUP, which is the dollar bullish ETF. Gold and precious metals mix. Now, gold actually had been positive going into the early afternoon around 2:30, flips and goes down to the downside. A lot of people think of gold as sort of an inflation hedge. A lot of times, an interesting thing to follow. So overall, finishing down about a third of a percent. Silver, the opposite, actually closing higher, came off in the afternoon as well, but finished up about three quarters of a percent. And energy was the number one sector in the of the 11 in the U.S. today. Finally, we have cryptocurrencies, which have in general been outliers in terms of their percentage moves. If you are not comfortable with volatility and extreme price movements, cryptocurrencies are not the asset class I would be focusing on. With Bitcoin up 6.5% from yesterday at this time when we were doing the show, it was quite the distribution yesterday. With Bitcoin just going below 40,000 for the first time in quite some while. You can see then we rotated back to the upside in the last 24 hours, have accelerated, touching 44,000. And we've talked about that 42 to 44,000 range being so important. That's been a level of support and resistance for quite a number of times in the last 6 to 8 months. We can see that both of those levels actually came into play today, and Ethereum, others overall finishing very, very strong today. Let's look at a chart of the S&P 500. Just think about the big picture environment. So, when you're looking at the S&P, I think it's a number of things you focus on. Number one is the trend, and that's got to be most important. And when I teach technical analysis, when I've taught it at the college level, when I've taught new analysts, new investors just getting started, I always help them lay out a checklist. What are the steps that you're going to follow to analyze the conditions on this chart? And if you don't use a checklist, you are basically opening yourself up to all sorts of behavioral biases that will basically get in the way of you making good decisions. So the benefit of using a checklist and laying out those steps is that you're much more likely to stay to a disciplined process of buying and selling. So what is the overall trend? Well, the Charles Dow's basic tenet is looking at highs and lows. An uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower lows and lower highs. So most recently, we're coming off of a new all-time high pretty much every month this year, where we've continued to go new highs. Early September, more of the same with a new high. So overall, I think the most recent swing high, increasing above the previous extreme. So that's overall a thumbs up. Where we start to get into a bit of decision making is with the new lows, right? We have arguably made a new swing low, depending on whether you determine that undercutting the August low on Monday's session was enough to trigger that condition. Overall, we've clearly made a lower low. The question is the follow through. And with yesterday sort of closing around the same level, with today bouncing higher, the question is, have we violated yet? And I think the other thing to point out when you look at the chart of the S&P 500 are the moving averages. We've talked about the 50-day moving average so many times. Again, I think this is a widely followed line in the sand. I've heard it from myself and many others in the industry talking about the importance of the 50-day and just the consistent nature of the 50-day as support. That has now failed. We've now broken below the 50-day moving average. We're actually touching the 100-day moving average, which I rarely show on my charts. But I on social media, a number of people were pointing out the fact that we just bounced off the 100-day. I popped it on here just so we could see where it is relative to the other moving averages we tend to focus on. So at this point, the 50-day has been violated. I think that's its value as a trailing stop at this point is no longer valued. The question then from here on out is what's next. Concerning things to me are the fact that we've now gone below that August swing low. We've undercut it. Now, we've undercut lows before. The question, as always, is the follow through. Do we continue to push in that new direction? And that's what we've not quite seen after Monday's sell off. Question number two, the RSI. Does it remain below 40, right? When the RSI is in a bullish phase, the whole range kind of bubbles up. You can see the RSI had not gone below 40 the entire year until this week when we finally dipped below there, indicating that the weakness this week was something a little more severe than normal. Last thing I'd point out in terms of the overall conditions, we talked about breadth a little bit yesterday, and just to review a couple of those charts very quickly, the cumulative advanced decline lines have all rotated lower here. Now we've had breadth deterioration, I think, in different forms for months now, right? And if you look at a lot of the breadth indicators, they made their peak in sort of April. A lot of them, when if you look at the percent of stocks above their 200-day moving average. And other indicators, they all sort of peaked in sort of that April to May timeframe. That's when the cyclical sectors like and things like financials and others were really rallying and made new highs there, and then started really come down. All these breadth measures have slowly but steadily been rotating more bearish. The S&P's advanced decline line is now below its 50-day moving average for the first time since back here, since last September. That was during that September October consolidation phase, that symmetrical triangle, that coil pattern before we made new highs again in November. So we're showing conditions that are less like this slow and steady uptrend, and more like something that's a little deeper, a little more significant. Finally, just very quickly looking at sectors, where do you hide in a market where the markets when stocks are starting to come down, when you have a lot of uncertainty, and that's an open question. We'll continue to sort of look at the charts and see what's working and what isn't. But what is working today is energy in a pretty big way. Energy, the number one sector, with the XLE up over 3%, followed by financials. And when interest rates are going up, financials tend to benefit a great deal from that. On the downside, utilities, communication services, which has been one of the leading sectors and also one that correlates very well to the S&P 500. We'll try to catch a little more on that after the break. We need to take a quick commercial break. We'll be back with my guest, Jay Petit. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close for our show. Thanks so much for spending some time with us every weekday live at 4 p.m. Eastern. A couple quick comments before we get to today's guest, Jay Petit. First off, questions are always welcome. Questions on how to use stock charts more effectively, questions on technical analysis, market history, investor psychology, whatever it is, we're happy to point you in the right direction. The best way to get your questions to us is via email. You can reach us at thefinalbar@stockcharts.com. You can also look us up on Twitter at FinalBarSCTV. We're on YouTube. Just bring up a video on the Stock Charts channel, put a comment below the video that you're watching. We'll capture all of those questions and hope to answer one of yours on our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. You can use your email address, set up a free account, start watching all of our great content from your mobile devices, also from our website. Great guests like Jay Petit and many others, special events like The Pitch and our mid-year market outlook, our year in review, and also great shows like The Final Bar. Go to StockChartsTV.com or just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Jay Petit. Jay is a CMT, he's the founder of Charts Avenue, very, very kindly getting up extra early and coming to us live from Singapore. Jay, welcome back to the show.
Hey Dave, thanks for having me.
It's a pleasure to catch up with you. We obviously have a market with an added dose of volatility recently. We just had the Fed meeting here a little earlier in the afternoon with the Fed chairman's comments sort of being digested with the market. What I really love is the fact that you're starting with a good long-term perspective, looking at a monthly chart of the XLY. What is this telling you?
That's right. So we start on the left-hand side of this XLR monthly chart by measuring the 2007 to 2009 decline to get the projected Fibonacci's extension levels. So you see here in blue. Fast forward to 2016, we can see how actually in late 2015 and throughout 2016, the price was hitting resistance around $81, which is the Fibonacci's 2.618 extension level. As XLR was kept under this resistance, the price action created an ascending triangle. And in January 2017, the price was able to break out to resume its uptrend. Then in 2019, XLR hit the next Fibonacci extension level at 121. The price action this time was volatile, to say the least, as XLR went back down to test the old resistance at 81, and confirming it as a new support. Mid 2020, the price was finally able to break out of this large broadening formation into new highs. That brings us to today, where XLY is reaching its next resistance level around 186. So it's going to be interesting to see how the price action will react to that 186 area. Is XLY going to correct through time and in an orderly manner as it did in 2016, or is XLY going to correct through price just like it did in 2019? Either way, as long as XLY is below 186, I would use shorter term strength to reduce position.
That's such a great take. And I love your implication there, Jay, about talking about the different ways the markets can correct. A lot of people think correction or hear correction and they think a sudden downturn in prices, which it certainly could be, which we saw obviously 2019 into 20, but it also can be more of an orderly sort of time correction at times, right? Depending on the
Correct.
dynamics. Now, one of the stocks, obviously in the consumer discretionary sector, Domino's Pizza, DPZ. Talk us through this one.
Well, we can see that DBZ is in a long-term uptrend. And from mid 2018 to early 2020, the stock went into a consolidation. It then broke out to resume its uptrend up to 427, which is the 2.618 Fibonacci extension level of that consolidation range. The price then retraced to the 340, 350 area, which is not only a Fibonacci extension level of the consolidation range, but also an extension level of the 2007 to 2008 decline. The price action in that 340, 350 area created a hammer candlestick that was back in March, which led to the next leg up. Interestingly, in May, the price stalled for a month at the 427 area with a doji candlestick. After this pause, the price continued north to hit the next extension level around 547. This was the July high. Then the August price action made an inside month, which shows indecision from the market. Now, there are still a few days before the close of the September candle, but the price already broke below last month's low, which indicates that DPZ wants to go lower, eventually back to that 427 area, which after being resistance in 2020 could become support. Now, even if the price were to retrace back to 427, the stock would still be making a higher low, which implies that Domino's Pizza's secular uptrend is still intact.
It's a fantastic take, Jay. And I really, again, I love the monthly point of view, looking at the long term. And it's so easy to get caught up in the short term movements in the market and not reflect on the long term evolution of things. With that sort of long term perspective in mind, we only have about a minute left. But when you're looking at the U.S. markets, obviously we've been in terms of the long term, right? We've just continued to make new monthly highs every month, and September's no different. We've continued to push higher. But some have argued, obviously, in the last couple of weeks, we've seen a bit of a change, right, with rotating below some key support levels, depending on how you look at it. Have you seen enough to start to think more defensively, broadly speaking? Or is there a particular signal or level that would tell you that conditions are really deteriorating to the point that you need to think cautious here?
I think the chart that you have right now on the screen, where you show the RSI, I think shows again that we broke below the 50 level. So it could be the start of a downtrend, but again, I think it's only a correction within an uptrend, which can be again through time, through price, or I heard you once say there's even a stealth correction. So that is something new to me. So I wouldn't be going again for a big, large correction, but I think reduce some position at this moment and we'll see how's the price action, and then we can add on again at a later stage.
It's a great take. Jay, listen, thank you again so much for giving us some time. I know it's early morning for you. We very, very much appreciate it. Merci beaucoup pour le temps today,
Merci à
aujourd'hui.
toi. Thank you so much.
Take care and stay safe, all right?
Thank you.
That's Jay Petit. Jay is the founder of Charts Avenue, coming to us live from Singapore. And Jay's a fantastic analyst, and I love the focus on the long term. And it's so easy, again, doing a daily show, it's so easy to get caught up in the short term. We really have to think as we're programming the show and as I'm bringing up charts to make sure we don't focus too much on the short term, but try to bring the long term context, bringing people like Jay on the show that illustrate the value of looking at monthly candles and just thinking about how some of these trends have evolved month to month instead of minute to minute. I think is a really good exercise. So some great ideas overall. I hope you found that to be time well spent. let's continue on with our next segment called "Don't Fight the Fed." As I mentioned, the Fed meeting today, and again, I'm often asked around things like earnings, the Fed meetings, things like that. Does it make sense to look at charts with the implication that this is the Fed doing something, right? This is Fed. It's a liquidity thing. It's an inflation thing. It's an interest rate thing. So why does technical analysis even matter? Does it have a place? And I would argue, I think what John Murphy taught me early on and continues to remind our subscribers is the fact that price has a value, right? The price represents the aggregate opinion of a bunch of investors, making decisions, making individual decisions that aggregate up to an overall market opinion or a market movement. Hank Pruden, who is unfortunately not with us, talked about the composite man, sort of the overall, sort of the personification of the market and what the market was actually doing and how to trade in relation to that. So, I would argue that it is always a good time. I'm obviously very biased being a technical analyst, but I think, to be honest with you, if you want to have a sense of what the market is anticipating, what the market is nervous about, excited about, euphoric about, desperate about, all of that is reflected in the price of assets. So, let's talk about the conditions leading up into today's Fed meeting. You had quite a bit of distribution here in the first couple weeks of September. This is after making a new all-time high a couple days into this month. From there, we've undercut the previous low that happened on Monday with the gap lower. Friday was really the day where we tested the 50-day and closed just below it for only the fifth or maybe sixth time so far year to date. Monday was when we really gapped lower, and this was market down a couple of percent, which was one of the strongest down days so far year to date. It certainly felt like a different environment. Now we've sort of chopped around, and I think the concern or the question when we look at the Fed minutes, when you hear the Powell's press conferences, they've very, very clearly telegraphed their game plan to change interest rate policy, right? To taper or to be a little less accommodative, to start to evolve their policy from a bond buying spree of sorts and start to lighten up. But again, today we're sort of left wanting any real specifics on that time frame. If anything, the time frame was sort of bumped up a little bit, right? You heard comments about the votes from the Fed governors were talking about the likelihood of raising rates in 2022, which almost all of them said was certainly likely, and that's more than it was the last time we had that survey. So while the calendar was kind of bumped up, it's still in the kind of stage. Right? It certainly felt to me like we're still talking about making changes as opposed to actually making changes, and the market certainly reflected that. The market bounced up, during the course of the day, expressing some optimism. Really didn't change a ton afterwards. You didn't have a severe move in the S&P action, and if you look at the chart of the S&P during the day, the moves were done before 2 p.m. Eastern, 2:30 Eastern, which is when the press conference really started to come out. From there, it was sort of choppy, right? So overall, I don't think there was a big vote one way or the other in terms of equities. It was more about a sort of choppy uncertainty afterwards. Now, other asset classes you saw a pretty significant move, and again, we're looking at some just short-term movements, and let's focus on the long-term charts together. So interest rates jumped higher, right? So going into 230, it was sort of a steady decline in rates with the 10-year yields hitting 130 from there, sort of rotating back higher and bouncing higher through the course of the afternoon. Gold and precious metals, and particularly gold, was the one that switched and gapped lower. And this is when they talked about some of the inflation things and what were baked in. In general, gold is seen as an inflation hedge. When people are worried about inflation, it tends to be expressed or implied through higher gold prices. We really didn't see that after 230. From there, inflation kind of came down as it talked about sort of their plans to accommodate or to aim for that 2% inflation over the long term, and what the short term readings that we've seen fit into that long term picture. Where we did see quite a bit of movement was with cryptocurrencies, and again, not much of that was afterwards. It was really through the course of the day, leading into the afternoon events, that you saw the increase in cryptos after being fairly weak in the last 24 hours. So we looked at the chart of the S&P. We've talked about overall, and again, I think talking with Jay, I was glad to hear his comments about just thinking about the overall dynamics. And again, we've hit some of these levels. The question is, do we get the follow through? Do we get some sort of downside movement continuing to indicate weakness in stocks? We've not really seen that since Monday, which was really the big distribution day. Let's look at some of the other asset classes here very, very quickly. We've talked about the chart of the GLD off and on, and just to review, looking at the GLD, the peak so far in the last 6 months has been at the end of May, early June, when the GLD bounced higher. traded just above 178, 179, really peaked out, got up near the highs from the fourth quarter of last year, and from there rotated lower. And I would argue from there, it's been a question of distribution. You've seen lower lows and lower highs. I think a real decision point for the price of gold was here in September, early September, that is, where you saw the GLD rotate back higher, touching that purple line, which is around 171.50. That was the peak in mid July and late July, again in early August. So a number of times that's sort of been, been resistance. We haven't really touched that level since. So at this point, I tend to think that trends are in place until proven otherwise. I'm seeing a pattern of lower highs. Now we're potentially seeing a higher low, and so it's in this certainly a consolidation phase over the last couple months. And so the question I think for a chart like this is, where do you resolve? John Bollinger always did a great job of talking about the market moving in a series of consolidations and then breakouts. Right, the market sort of settles into an equilibrium, and then we decide what's going to happen next. Buyers or sellers take control and push the price out of that move or out of that range. For the GLD, I think there's a really clear line in the sand around 171.50. But again, I think the longer term trend overall has been net negative. It's been flat to negative, and depending on the time frame you look at, this is a consolidating market, really just going directionless, sort of going that painful third direction of sideways, or it's something still in a downtrend. It's really nothing I'm seeing in here is necessarily constructive. And I would say the lows from the last week or two could be an interesting level to watch as well, around 163. Just very quickly, and then we really need to wrap up and finish off the show. Interest rates. So we talk about interest rates off and on. It always tends to come up around Fed meetings, because a lot of times the policy decisions, the implications are reflected in the bond markets. And when you're thinking about asset allocation between stocks and bonds, it's clearly been favoring stocks for so long, because bond prices have essentially just been underperforming overall for quite some time. The question is, where do interest rates net out? Now, the low watermark, or the low has been in July, early August, when the 10-year yields bottomed out just above 111, right? And this was the swing low. We obviously were much lower there in 2020, but spiked up to around 175 here in March, early April. We then settled back in, and we've hit a low around the July, August level. From there, we've sort of been appreciating or seen higher rates, weaker bond prices, and now we're settling in here. I think it's really interesting to see the RSI failing to get above the 60 level for me to really feel like rates had the chance to go higher and retest some of these previous levels. You'd really need the RSI to get above 60, because that means the whole thing is more in a bullish range. Right now, it's still sort of in that bearish range, suggesting that the weight of the evidence is still sort of lower rates until proven otherwise. But again, we've bounced up quite a little bit. The question is, can we remain? Can we get an RSI that indicates stronger upside momentum? We need to wrap the show. The 3 and 3, 3 charts in 3 minutes. Here we go. Chart number one, and there's sort of a breadth theme to a couple of these, or a rotational theme, I guess. Chart number one is the McClellan Summation Index. We talk about a number of breadth indicators through the course of our show. The McClellan Oscillator is a way to look at advancers, decliners, but smoothing out with some moving averages to look at the trend in advancers and decliners. The Summation Index is a way of aggregating that McClellan Oscillator to look at trends in moment, or trends in breadth, and tracking them over time. It's interesting to see that this has overall been in a downtrend for quite some time. Really, the entire year 2021, it's been net negative. Although April, May, June, you saw the cyclicals reemerge in a position of strength. You saw the McClellan Summation Index make a new swing high. From there, though, it's gone lower. It's undercut the zero level, and overall, this suggests to me some internal weakness with weaker breadth trends, mirroring what we've seen elsewhere. High beta versus low volatility has come up. This is using two ETFs that track those baskets of stocks. When you see this ratio going higher, this is saying some of the high beta sectors in this ETF, it's a big exposure to things like financials and technology, I think, are the two biggest sectors, just potentially making a new swing high for the last couple months. Low vol would be sort of boring defensive things like utilities. And so this is indicating it's not really a distribution phase yet using that ratio. Finally, we talked yesterday about Dow theory. I got a little pushback in social media for looking at the traditional Dow theory of the Dow Industrials and Dow Transports. I still think that's valid, but this is what I call the new Dow theory. The S&P has undercut its August low on a closing basis. The NASDAQ Composite has not. Folks, that's our show for today. Special thank you to Jay Petit joining us from Singapore, giving us his thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.